a recurring pattern throughout financial history, has led to the decimation of savings for countless individuals over the past 15 years. Presently, in the year 2025, the legislative groundwork is firmly established for this very scenario to unfold within the United States. Back in 2013, Cyprus awoke one morning to find its financial institutions shuttered. Upon reopening, a staggering 47% of all deposits exceeding €100,000 had vanished. Not stolen, but legally confiscated by the government to shore up failing banks. 2 years later, in 2015, Greece implemented stringent capital controls, restricting citizens to withdrawing a mere €60 per day from their personal accounts. Your funds were effectively immobilized, inaccessible for transfers, or even to be taken out of the country for months on end. Then in 2019, Lebanese banks froze all customer accounts. Individuals with millions in savings found themselves limited to withdrawing no more than $200 weekly. This restriction persists to this day. 6 years later, their money effectively lost, ensnared by a broken system. 3 developed nations, 3 instances where governments legally appropriated depositors' funds, not through taxes or inflation, but directly from bank accounts. What should truly alarm you is that the legal apparatus for implementing such measures already exists in the United States, enacted in 2010 via the Dodd-Frank Act. It is termed bail-in authority. When the next banking crisis inevitably strikes, your deposits will serve as the primary resource, not government funds or Federal Reserve loans. Your money will be the target. This is the narrative of how contemporary governments seize bank deposits, the legal justifications behind it, and why your hard-earned savings may not be as secure as you believe. Before delving into the historical patterns, it's crucial to grasp the essence of a bail-in and how it diverges from preceding interventions. During the 2008 financial crisis, governments intervened to rescue collapsing banks, utilizing taxpayer funds, printed money, and emergency loans. The bank's liabilities were effectively transferred to the public, understandably sparking widespread outrage. The notion of too big to fail morphed into too big to save. The ensuing political backlash was immense. Consequently, in 2010, governments in both the US and Europe enacted new legislation, ostensibly to prevent future bailouts. The stated objective was that banks should face consequences for poor investment decisions, with no further taxpayer-funded rescues. While this sounds reasonable, here's the critical aspect. When a bank falters, someone must absorb the losses. Shareholders are the first to be impacted, naturally, followed by bondholders. However, if these measures prove insufficient, and the losses exceed the combined value of equity and bonds, who is next in line? Depositors. Those individuals who believe their funds were secure within the banking system. This is the core of a bail-in. Instead of the government rescuing the bank with public money, the bank essentially rescues itself by leveraging depositor funds. Overnight, your savings are transformed into the bank's capital, often without any prior notification or your consent. This is legally sanctioned and has already transpired 3 times. Let's examine the initial global manifestation of this practice. Cyprus, in March of 2013, served as the blueprint. This small island nation in the Mediterranean, home to approximately 1.2 million people and a member of the European Union, adopted the euro. Throughout the 2000s, Cyprus emerged as a prominent banking hub, attracting significant capital from Russian oligarchs, European corporations, and affluent individuals seeking its low tax rates, banking secrecy, and access to the Eurozone. By 2012, the Cypriot banking sector held assets equivalent to 800% of the nation's gross domestic product, an 8-fold expansion. Its 2 largest institutions, Bank of Cyprus and Laiki Bank, had grown excessively large, far beyond the nation's economic capacity. These banks had made substantial, risky investments, notably acquiring vast quantities of Greek government bonds. These bonds offered attractive interest rates, ranging between 10 and 12%, leading Cypriot banks to amass considerable holdings. However, when Greece faced its sovereign debt crisis in 2010 and again in 2012, the value of these bonds plummeted. Greece underwent a debt restructuring, resulting in bondholders incurring losses of 50 to 70%. Cypriot banks, holding billions in these devalued Greek bonds, found themselves insolvent, their losses exceeding their capital, effectively bankrupt. Yet they remained operational as the reality of their losses was deliberately obscured, a practice common when admitting failure is politically inconvenient. By early 2013, this charade ended. The banks required a substantial recapitalization, amounting to 10 billion euros. However, Cyprus's total GDP stood at merely 18 billion euros, far beyond the government's capacity to provide the necessary funds. Consequently, Cyprus sought assistance from the European Union and the International Monetary Fund. The EU agreed to provide financial aid, but with a non-negotiable condition. Cyprus had to implement a bail-in of its depositors. On March 16, 2013, Cypriot banks ceased operations, commencing on a Saturday with no prior warning. Depositors woke to find ATMs inoperable, bank branches locked, and a government announcement detailing a stability levy, a one-time tax imposed on all bank deposits. The banks eventually reopened on March 28, nearly 2 weeks later, but under strict capital controls, preventing any funds from being transferred out of Cyprus. Fast forward 2 years to the summer of 2015, and Greece found itself deeply mired in its sovereign debt crisis, having endured 5 years of austerity measures. Its GDP had contracted by 25%, and unemployment soared to 25%, yet it remained unable to service its debts. In June 2015, negotiations with the EU and IMF faltered, precipitating an imminent Greek default. The Greek populace, having witnessed the Cyprus situation, understood the implications. A default would trigger bank collapses, leading to the seizure of deposits. Consequently, Greeks began withdrawing funds en masse. In the single week between June 15th and June 21st, a staggering $8 billion was withdrawn from Greek banks, initiating a bank run. The banks were hemorrhaging liquidity, and their reserves were rapidly depleting. On June 28, 2015, the Greek Prime Minister appeared on television, announcing a referendum on the bailout proposal and declaring that banks would close the following day. These closures, initially slated for 1 week, extended to 3 weeks before full reopening, at which point severe capital controls were instituted. The restrictions were draconian. Greeks were limited to withdrawing €60 per day from ATMs, approximately $65 at the time. This meager sum was intended to cover essential expenses like groceries, rent, and medication. Pensioners without ATM cards could withdraw €120 weekly, but only once from a branch, often after enduring hours of waiting in the summer heat. International wire transfers were prohibited, making it impossible to pay foreign suppliers or import goods. Businesses faced immense difficulties, and individuals were unable to send money to family members abroad. The economy devolved into a cash-dependent system, with insufficient cash available. While Greece did not enact a direct bail-in like Cyprus, confiscating a percentage of deposits, it implemented a measure arguably more devastating. It trapped the money, rendering it unusable. If one cannot access their savings, or is limited to €60 daily, does that money truly belong to them? In practical terms, it has been effectively confiscated. The balance may appear in one's account, but it remains inaccessible, trapped. These capital controls officially remained in effect until 2019, a period of 4 years. Even after their eventual lifting, the lesson was deeply ingrained in the Greek psyche. Distrust the banks and keep your money elsewhere. To this day, Greeks often hoard cash at home or move it abroad if possible. Bank deposits in Greece remain below their 2009 levels, 16 years later, a testament to the irreversible damage inflicted upon public trust. The lesson from Greece is clear. Even without a formal bail-in, governments possess the power to immobilize your funds through capital controls, making them inaccessible and practically worthless, with restrictions potentially lasting for years. While Cyprus was a small nation and Greece was grappling with severe economic distress, the notion that such measures are confined to struggling economies was dispelled by Lebanon. This case demonstrates that such actions can also impact middle-income countries with well-established financial systems. Let us now turn our attention to Lebanon, a situation that commenced in 2019 and is ongoing, arguably representing the most severe instance to date. For decades, Lebanon was referred to as the Switzerland of the Middle East, with Beirut serving as a major financial center and Lebanese banks widely regarded as stable. The Lebanese pound had been pegged to the US dollar at a rate of 1,500 to 1 since 1997, maintaining remarkable stability for over 2 decades. Furthermore, Lebanon's banking sector was substantial, with bank assets representing 400% of its GDP by 2019. However, beneath this veneer of stability lay a precarious structure akin to a Ponzi scheme. The Lebanese government was running substantial annual deficits, amounting to 10 to 15% of its GDP, necessitating constant borrowing. Lebanese banks became major purchasers of these government bonds, offering interest rates between 8 and 12%. The banks acquired these funds by attracting deposits from both Lebanese citizens and foreigners, drawn by the high interest rates. These deposited dollars were then channeled into purchasing government bonds. This arrangement functioned as long as a steady inflow of new deposits continued, effectively a Ponzi scheme where new deposits serviced the interest on older ones and funded the government. By 2019, this unsustainable model began to unravel. The government could no longer secure new loans, and international lenders ceased their financial support. Foreign currency reserves dwindled, and depositors grew increasingly apprehensive. In October 2019, widespread protests erupted in response to new government taxes, leading to public demonstrations. Concurrently, a subtle but persistent bank run began as individuals attempted to withdraw dollars. However, the banks lacked sufficient dollar reserves, having lent them to the government, which had subsequently expended them. By November 2019, banks started imposing withdrawal limitations, initially informally, then officially. Weekly withdrawal limits were reduced from $1,000 to $200, then to $100. By early 2020, many banks permitted cash withdrawals of only $50 to $100 per week. The most cruel aspect of this situation was that account statements continued to display full balances, and these restrictions remain in place today, 6 years later. The banks have never returned the funds. The government defaulted on its debt in 2020. The currency became virtually worthless, and depositors found themselves stranded. Some have resorted to legal action, while others have resorted to forceful means, storming banks with weapons to reclaim their own money. This has led to hostage situations, where desperate individuals, driven to extreme measures, have taken bank employees hostage to demand access to their savings. In 2022, one man famously held up a bank at gunpoint to withdraw $5,000, essential for his father's medical treatment. He became a folk hero, as virtually everyone in Lebanon faced similar predicaments. The lesson from Lebanon underscores the fundamental reliance of modern banking on confidence. When confidence erodes, banks can simply refuse to disperse funds indefinitely. The government offers no recourse, and the courts are powerless because the money has been lent to an insolvent government or lost through imprudent investments, leaving depositors as mere creditors to a failed institution. 3 nations employing distinct mechanisms yielded a uniform outcome. Depositors lost access to their funds. Cyprus experienced a direct bail-in, with 47% of deposits seized and converted into devalued shares. Greece imposed capital controls, trapping money and limiting daily access to $60. Lebanon implemented an informal freeze, where money remained visible in accounts but was practically impossible to withdraw. In all 3 instances, individuals who believed their money was secure within the banking system were mistaken. Moreover, these actions were either legal or went unpunished. Let us dissect the underlying pattern, which exhibits remarkable consistency across these events. The United States is currently exhibiting all the requisite warning signs. Stage 1 involves the banking sector becoming excessively large relative to the overall economy. In Cyprus, it was 800% of GDP, in Greece, 300%, and in Lebanon, 400%. When a banking sector's scale is multiple times the size of the national economy, the government lacks the capacity to bail it out if it fails. It is a mathematical impossibility. In the United States, the 6 largest banks collectively hold assets exceeding $12 trillion, representing 43% of the nation's GDP, concentrated within just 6 institutions. A simultaneous failure of these entities would render any bailout insufficient. Stage 2 entails banks engaging in risky investments. Cypriot banks purchased Greek government bonds that subsequently collapsed. Greece extended credit to an insolvent government. Lebanon operated a Ponzi scheme involving government bonds. Banks undertake risks because, during prosperous times, they realize substantial profits, and during downturns, they anticipate government bailouts. A classic case of moral hazard. In the U.S., banks currently hold approximately $500 billion in unrealized losses on their bond portfolios. The commercial real estate sector is experiencing a significant downturn. The failures of Silicon Valley Bank, Signature Bank, and First Republic Bank in 2023 served as stark warnings. Stage 3 involves a crisis trigger exposing these underlying risks. In Cyprus, it was the Greek debt restructuring. In Greece, a sovereign debt default. and in Lebanon, the government's exhaustion of foreign currency reserves. An event occurs that reveals the bank's losses, making them impossible to conceal further. In the US, the trigger could be a recession, a commercial real estate collapse, rising interest rates that render bond losses unavoidable, or a geopolitical crisis leading to capital flight from the dollar. The specific trigger is secondary. The vulnerabilities are already present. Stage 4 witnesses the onset of bank runs. Once the risks become apparent, individuals rationally attempt to withdraw their funds. In a fractional reserve system, banks maintain only about 10% of deposits as reserves, lending out the remainder. Consequently, if everyone attempts to withdraw simultaneously, the bank will fail. In all three cited examples, bank runs either commenced or were imminent when governments intervened. In the US, we observed numerous bank runs in 2023. Silicon Valley Bank experienced $42 billion in withdrawals within a single day before regulators intervened to shut it down. The infrastructure for digital bank runs, enabling fund transfers via mobile applications, renders modern runs faster and more destructive than ever before. Stage 5 involves government intervention to avert total collapse. However, this intervention comes at a cost, borne by depositors. Cyprus experienced a bail-in, resulting in seized deposits. Greece implemented capital controls, trapping funds. Lebanon imposed an informal freeze, leading to indefinite restrictions. What will be the US response? The law already sanctions bail-ins. Section 206 of the Dodd-Frank Act empowers the FDIC to resolve failing banks by converting deposits into equity. Your cash could become ensnared in a failing institution. The legislation is in place. It simply has not been invoked yet. Stage 6 entails years of economic hardship. Even after the immediate crisis subsides, the damage lingers. Cyprus required years to recover. Greece continues to grapple with the repercussions. Lebanon faces a humanitarian crisis. This is because once individuals lose their savings and trust in banks is shattered, it is exceedingly difficult to regain. People resort to hoarding cash, businesses struggle to obtain credit, and investment stagnates, leading to economic decline. This constitutes the pattern. 6 distinct stages. The United States has successfully navigated stages 1 through 4 and is currently entering stage 5. The seeds of the next banking crisis are being sown right now. Let's examine the specific vulnerabilities present. Firstly, the unrealized losses within regional banks. As the Federal Reserve aggressively raised interest rates from near 0 to 5% between 2022 and 2023, bond prices experienced a sharp decline. Banks hold trillions in bonds, and these bonds are now worth considerably less than their original purchase price. Under current accounting rules, banks are not obligated to recognize these losses as long as they hold the bonds to maturity. However, if depositors withdraw funds, banks are compelled to sell bonds to generate liquidity. Upon sale, these losses are realized and the losses diminish capital. If this reduction is substantial enough, the bank becomes insolvent. Silicon Valley Bank failed precisely due to this mechanism, holding $16 billion in unrealized losses. When depositors withdrew funds, the bank was forced to sell bonds, realize its losses, and consequently collapsed. Numerous regional banks are in a comparable predicament. Secondly, commercial real estate poses a significant risk. Office buildings have depreciated by 40 to 50% since 2019 due to the rise of remote work. Yet banks continue to lend against valuations based on 2019 market values. There are $3 trillion in commercial real estate loans held by U.S. banks. When these properties are refinanced or sold at current depreciated values, banks will incur substantial losses. New York Community Bank narrowly avoided failure in early 2024 due to its exposure to commercial real estate. It is far from alone. Thirdly, FDIC insurance is largely illusory. The FDIC maintains an insurance fund of approximately $125 billion, while total insured deposits in the U.S. amount to roughly $10 trillion, representing a mere 1.25% coverage. Should just 2% of banks fail, the fund would be depleted. Furthermore, there are over $18 trillion in total deposits, the majority of which are uninsured for amounts exceeding $250,000 in any single institution. Even for deposits below this threshold, if a sufficient number of banks fail concurrently, the FDIC will lack the necessary funds. They would be compelled to seek loans from the Treasury or the Federal Reserve, which implies printing more money, thus fueling inflation. You face a choice. Either lose your deposits directly or see their value eroded through inflation. Thirdly, digital bank runs are virtually unstoppable. In the past, bank runs unfolded gradually, requiring physical presence and waiting in line. Today, one can withdraw $50,000 via a mobile app within 30 seconds, transfer it to another bank, or purchase cryptocurrencies. Silicon Valley Bank witnessed $42 billion in withdrawals in a single day, representing 25% of its total deposits, vanishing within 24 hours. No bank can withstand such a rapid depletion of funds. Moreover, the failure of one bank can instantaneously trigger widespread panic, amplified by social media, leading to simultaneous withdrawal attempts from similar institutions. This represents a complete collapse scenario. Fifthly, the bail-in legislation is already in place. The Dodd-Frank Act explicitly grants the FDIC the authority to resolve failing banks through bail-ins during systemic crises. So, what lies ahead? Let us envision a plausible scenario. It is late 2025 or 2026. A recession takes hold, leading to rising unemployment and corporate defaults. Commercial real estate loans begin to falter. A major regional bank announces significant losses, triggering depositor panic and subsequent withdrawals. The bank fails and the FDIC takes control. However, the FDIC's reserves are insufficient to cover all deposits. Other banks with similar risk exposures experience runs. 3 additional banks collapse within a single week. The FDIC fund is nearly exhausted, the stock market plummets by 20%, and credit markets freeze. The president declares a financial emergency. Over the weekend, capital controls are announced, imposing withdrawal limits of $300 per day from ATMs. Transfer limits restrict amounts exceeding $10,000 without prior approval. International wire transfers are suspended. Simultaneously, the FDIC announces that deposits at failed banks exceeding $250,000 will be converted into equity. In a bail-in scenario, if you had $500,000 in the bank, $250,000 would be insured, while the remaining $250,000 would be converted into shares of a bank now valued at perhaps 20 cents on the dollar. 3 times in recent history, in 3 different countries, depositors learned a harsh lesson. The money held in a bank is not truly their own. It represents an unsecured loan to the institution. In times of crisis, this loan can be converted into equity or frozen indefinitely. Cyprus demonstrated the legality of bail-ins. Greece illustrated how capital controls can persist for years. Lebanon revealed that banks can simply refuse to return your funds, leaving you powerless. The United States already possesses the legal framework for both bail-ins and capital controls. The inherent vulnerabilities are extreme, the warning signs are ubiquitous, and historical patterns indicate an impending crisis. You may have 6 months, perhaps a year, or even 2 years. However, the mathematical probability suggests inevitability. Therefore, what steps can you take? Firstly, recognize that bank deposits are not savings. They are unsecured loans to the bank. If the bank fails, you become a creditor, not a depositor, and creditors absorb losses. Secondly, avoid concentrating all your funds in a single institution. Never keep more than $250,000 in any one bank. Diversify your holdings to mitigate single points of failure. Thirdly, maintain a portion of your funds outside the formal banking system in physical cash. In the event of capital controls or bail-ins, cash in hand will be your sole accessible asset. Fourthly, consider hard assets such as real estate or gold, which exist independently of the banking system and cannot be frozen or subjected to bail-ins. Fifthly, develop a contingency plan. Know precisely what actions you will take if capital controls are announced, where you will move your money, and what assets you will acquire. Once the crisis unfolds, you will not have the luxury of time to formulate such a strategy. Sixthly, understand that the government's primary objective will be to protect the system and the banks, not individual depositors. If seizing your money is necessary to achieve this, they will do so, as evidenced by Cyprus, Greece, and Lebanon. U.S. law permits it, and it will occur when the crisis strikes. 3 times in 12 years, governments have legally appropriated depositors' funds. Each time, individuals believed they were secure, and that such an event could not happen to them. Each time, they were proven wrong. The pattern is undeniably clear. The legal framework is established, the vulnerabilities are profound, and history provides an unassailable preview of what is to come. The only question that remains is whether you will anticipate it before your money is irretrievably trapped. If this exposition has opened your eyes to the impending realities, please subscribe, because when the next banking crisis erupts and your funds are frozen or subjected to a bail-in, you will need to understand precisely what has transpired and why. The answers are not hidden in some distant future. They are etched in the past, and I will guide you to them.